You're about to make a hiring mistake. You're hiring a bookkeeper or a controller or start budgeting for full-time finance people. And every founder at your stage does exactly this. Here's the problem. The job that you're about to hire for is being automated right now. Not in 2 years, right now. Pilot launched a fully autonomous AI accountant this year. It closes books every month, zero humans involved. The founders who don't know this are about to spend thousands a month on a finance team that does half the work of a software stack costing fraction of that. In this video, I'll show you exactly what your finance team needs to look like in 2026, layer by layer for a startup under $2 million in revenue. My name is Kishore Dasaka and I run a fractional CFO firm for startups. We've been building these finance functions in real time and here's what we are seeing. Number one, the accounting layer is almost gone. Let's start right at the base. Invoicing, accounts receivable, accounts payable, bank reconciliation, expense categorization. Now, this is all the stuff that used to take people, junior hires, bookkeepers, admin staff. That layer is completely getting automated right now. Software like Puzzle connects directly to Stripe, Mercury and Gusto and auto-categorizes expenses with almost 98% of accuracy. And after that, it also learns your patterns. Tools like Ramp handles AP automation and real-time expense tracking in a way that would have taken a 2% team 3 years ago. Pilot's AI accountant handles the entire monthly close. No human touches it. Now, these are not random pilots or random startups that have spawned up. Thousands of startups are running these tools today. So a founder under $2 million of revenue, your accounting layer should be almost entirely software. You might need one person to review it, obviously, and sign it off, but you don't need a full-fledged team. Number two, the controller layer is going fractional. This is the one that surprises most founders. The traditional controller checks that everything's posted correctly. Journal entries, accruals, prepaids, the close and all that. Important work, but it used to require someone expensive inside your company to handle this full time. Here's what's changed. AI can now run these exact checks at a granular level on a schedule with more consistency than any human. Tools today sync with your general ledger every 5 to 15 minutes. They flag anomalies automatically. They draft variance commentary. They surface anything that needs a human call. So what does the controller actually do now? They monitor whether the agents are running. They review the exceptions. They make the judgment calls on the edge cases. We've started calling this the agent controller, fractional part-time, someone who has deep accounting knowledge, whose job is to manage workflows, not to do them. For a sub $2 million startup, roughly about 10 to 15 hours a month is almost always enough. Their job isn't to do the work, but their job is to make sure that the systems are doing the work and running properly. The third one is the FP&A layer that is being hit the hardest. If your accounting layer surprised you, this one will surprise you even more. The analysis, the variance commentary, the what-if scenarios, and the reforecasting. 60 to 70% of that work is already being automated today. Tools like Drivetrain run thousands of scenario models in seconds. Tools like Numeric generates variance commentary that automatically comes from your GL data. The manual work of pulling numbers, building models, writing the narrative, now that is becoming software. So what does that mean for your team? At a sub $2 million revenue, you don't need a dedicated FP&A analyst today. What you need is someone who can interpret the outputs that the AI generates, someone who looks at what the model says, and someone who tells you what the decision is pointing towards. Now that is not a strategic skill. Now that is a mechanical skill, and it doesn't need to be full-time. The fourth one is that the compliance is staying human. Now here's the honest caveat. Not everything is getting automated today. Tax filings, regulatory compliance, statutory reporting, these are all still largely human work. Not because the tools aren't improving, they obviously are, but the stakes in these cases are really high. You cannot afford to take a risk with an AI model to do your end-to-end compliance. And also, the regulations keep changing. And the liability sits with someone who has to really sign off on these papers. AI isn't ready to be that person yet. So the compliance still stays human, outsourced at your stage, probably to a CPA or a CA or a retainer basis accountant. Every other layer is moving towards AI first. Compliance is moving towards AI assisted, and that is the real difference. The fifth one is that the CFO role is changing, not disappearing. So with all of this shrinking, does the CFO go away? No. But what they spend their time on shifts completely. Historically, a lot of CFO bandwidth went into building reports, managing the team that built the reports, and translating data into something that a founder could use. In 2026, that data is already surfaced. The analysis is already run. The reports are already being drafted by AI. So the CFO configures and monitors the AI workflows and makes the call on things that really matter. Now that is irreplaceable, but doesn't need to be full-time until you are somewhere in the $50 to $100 million range. A fractional CFO who shows up for big moments is good enough. The fundraise, the pricing call, the runway crisis. And here's the thing, the value you get from a fractional CFO is higher now than it has ever been before. Because they're not walking in to build spreadsheets. They're walking in with AI-powered outputs that are already prepared. They're spending your money thinking and not formatting an Excel sheet. Here's what the finance team actually looks like in 2026 for a tech startup that is under $2 million in revenue. An AI-first accounting layer, almost no human intervention. A fractional controller, about 10 to 15 hours a month. No dedicated FP&A analysts. The models run by themselves, but someone interprets them. Outsource compliance to a CA on a retainer. And a fractional CFO for the decisions that actually matter. The founders hiring full-time teams the old way aren't being careful. They're being expensive. The finance function that used to cost several thousand rupees a month can now run on fraction of that and give you even better, faster, and more accurate insight. But only if you build it the right way.